Welcome. It's great to be back. I often, when I'm getting ready for my talks here, I usually start by looking back at what did I say last time, so I can check on that and see if the message is at all consistent. Last time I stood up here and I talked about two potential paths forward, and those paths depended on whether we got a deal in the trade war. And I had, at that time, the outlook that I think most of the market shared, which was that a trade deal was really darn likely, that China and America both stood to benefit so much from a trade deal that it was likely going to happen. And so I talked about what that meant for the metals markets. And you can see that the markets broadly shared that perspective because they staged an impressive rally in the first 4 months of the year, right? After that precipitous decline at the end of 2018, they went crazy and reached new highs. And that was all based on this mentality that, well, we have to come to a deal, right? It has to happen. Of late, that I think has changed in fundamental ways. And so the broad markets are coming off. And it has significant implications for the metals space as well. So that, I think, that's why my topic this time is preparing for a protracted trade war instead of what are the two paths ahead, and I think we're going to get the good ones, so yay. Unfortunately, things have changed. And this all matters, of course, because the trade war has real impacts. I talked about this last time. I think we all would broadly agree with this, so I'm not going to linger on it. But growth is absolutely slowing around the world because of tariffs, because of the fear of tariffs. And then there's other aspects that layer on top of it, including Brexit, that make it worse. There's lots of statistics and charts and whatnot that one could use to back up that point. The two that I have here on the left, we have U.S. industrial production, showing percent decline year over year for each month, and that is certainly on a downtrend. On the right, we have the latest print for global manufacturing PMI. You can see that it's been up and down since the last recession, which is the spike on the side of the chart there. But right now we are in a down part of that, and it started almost coincident with the start of the trade war. They are very related. And when you do the surveys that happen alongside these questionnaires, most of the survey respondents point specifically to tariffs and trade war concerns as the reason for not pursuing additional investments or holding off on making deals. So the trade war is having very real impacts. Meanwhile, is there just a recession ahead broadly? Well, that's a question that's been lingering for a very long time. I'd say for quite a few years now in this plow horse recovery that I think is a good term to describe it. It's slow and steady and not very exciting, but it's been working. Everyone's been wondering, well, when's it going to end? The bull market has been fantastic. Everybody gets a little worried the longer something stays good. And now I would say the recession indicators are continuing to strengthen. So we're still in a situation where the market's richly valued, but we are seeing fewer share buybacks, so that's important. Growth is, as we've seen quarter after quarter here, moderate at best, and inflation is missing, which is important when you're trying to understand whether growth is consistent. The bull market is just old. The trade war is piling on top of it. This is just one example of, again, another. You could use lots of pieces of data to talk about this, but this happens to show corporate debt and the correlations between peaks in corporate debt and recessions. And guess what? The pattern is pretty obvious right now that we're getting close to that kind of a scenario. If we want to use one other indicator, this is one that I just came across, a new update that I came across yesterday. So the, the Chicago Fed National Activity Index, had to look down to remember the full acronym there, is a composite of 85 indicators of economic activity. If it's 0, then you're just right in line with historic averages. If it's positive, then you have strong growth. And if it's negative, you have below average growth. And again, it's wavering. It's up and down, but we did have a pretty significant decline in the last two readings, so from plus 0.05 to negative 0.45. This is a long-term indicator, and if you go to negative 0.7, that is strongly correlated with recession. So this is just another example of how there's reason for real concern ahead. And so when you layer that real concern, big picture economy, when you layer on top of that trade war concerns, you get into a slightly precarious situation. And those trade war concerns are very real. So what has changed so significantly is that everybody had this mentality, these are huge economies, we need to come to a deal, right? Obviously. Except in the last week, 2 weeks, it's become very clear that the United States is focusing on precisely the things that were never going to be resolved in any way easily. I think those who gave it some thought, if we thought that there was going to be a trade deal, we always assumed that these sticking points were going to be somewhat put to the side, and a deal would come out that would address a bunch of other things that were more economic and tangible, but that these sticking points would be left to the side. From Trump's recent actions, it's clear that the United States instead is focusing specifically on these intractable issues, and that is why we are at such an impasse. So the things that matter are China's lack of protection of intellectual property, China's subsidies to strategic industries, and China's approach to privacy. And these are things that China will not change. And the latest pressures that have been exerted on Huawei are proof of that focus. So if Washington is serious about forcing China to play by Western rules around intellectual property, privacy, and level playing fields, then they have to go after the behemoth example who is violating all of those, and that's Huawei. And so we are at the situation where we're at right now, where Trump issues executive orders around protecting American intellectual and communications privacy. Doesn't mention Huawei, but it's all about Huawei. And so now we're at a real impasse, and that means we have to settle in for a long trade war. So what does that mean? Well, the worse the trade war gets, the better for gold. That seems like a bit of an empty statement right now because gold hasn't done anything yet, right? No, it hasn't, and that's unfortunate. But I think that that's because this mentality that investors have had about, well, we have to come to terms on this trade war, that's still sticking. It takes a long time to turn a ship around, and this ship that we're turning around is the 8-year bull market. It's everyone's desire for that bull market to continue. It's the general belief that that economic interests have to come first. And so it takes a while to turn around on those opinions. That is starting to happen, though. These forces, the idea that a trade deal had to happen has maintained optimism. It created that bull market, or the continuation of the bull market that we saw from January through April, but the optimism is now starting to fade because of all the new tariffs. The sides are basically not talking right now. This U.S. National Executive Order, which is an emergency order about Huawei. Global growth is weakening, and it will continue to weaken without a deal. And then it is also important, China can't tariff as many things as America can tariff, because there's an imbalance there, a significant one. But China can certainly act very strategically in what it does apply, and if it decides to pursue that path, which it has with rare earth elements, and I'll mention that a little bit more in a moment here, there are ways that they can hit home quite hard. So the worse this gets, the more the average investor is going to accept that the ship is turning around, that this is real, this is bad, we're not going to come to terms right away, and therefore the underlying optimism that has fueled the bull market has changed. If growth in that context slows enough that the Federal Reserve cuts interest rates, which is certainly possible, that is when gold will really go. I think it will go before then, but that is when gold will really go. And why is that? Well, certainly, this is just the classic reasons why gold gets safe haven buying, right? Concerns about growth, stock market weakness, the US dollar either pausing or getting weaker, and real rates sideways to lower. We are already in the situation where we have number 1, number 2, and number 4, and all of those will continue to strengthen as the trade war gets worse. We don't have number 3, we don't really have a pause in the US dollar, but that's still a volatile, or that's still an uncertain situation. And I just put this Kitco chart up right now. You can see the red line is the track for gold yesterday. And guess what? Gold made a move up yesterday, the dollar made a move down, and it was all because of trade war concerns. So you can see that the reaction is there. The reaction isn't huge yet, but it absolutely exists. And so it will get bigger as more and more people accept that this trade war is a very significant and lasting situation. So that's the outlook for gold in the trade war. The worse the war, the better for gold. The unfortunate side of it is for base metals. And I made a comment at a dinner last night that I just don't know what to do about copper anymore, because the fundamentals for copper are incredibly strong. All of these charts have to do with copper. The supply-demand gap is clearly very large as you progress forward. We have hardly any copper sitting in stockpiles. That's the chart on the right. And then the sentiment index just captures how the spot price does react to copper sentiment. And you can see that copper sentiment has fallen to the floor. And that's because of the trade war. And so it's a really unfortunate scenario where we have a very bullish setup for copper, where we have insufficient supply. We don't have the pipeline of projects. We have a supply gap coming forward. This is the metal of electrification. This is the metal of the growth. This is the metal that we can't function without. And yet it's being driven by sentiment, and it has been driven by sentiment for the last 18 months at least, and in that situation is continuing. So I wish I had a magical answer to tell you what to do about copper right now. The big picture is that I still believe that copper will have to have a bull market. It is being delayed. It's not being denied. It can't be denied because these charts say so. But it is being delayed, and that means copper spot price and copper, therefore stocks, are probably not going to have a very exciting near term, but the outlook is still as stable as it has been, as bullish as it has been. So if that's my big picture outlook, what do you do about it all? Well, as the trade war pressure rise, you have to position for, I would say, low risk gold gains, because that's the opportunity that's laid out before us. When a gold market is weak, or when a gold market is frothy, the low risk gains have largely happened, or don't exist, I suppose. But when you're looking ahead to a significant rise as safe haven buying becomes a movement, then you have the opportunity to take advantage of low risk gold gains. So I think that's quite important, because as a crowd here, we all love exploration, we're all really interested in exploration, and don't worry, on the next slide I'm still going to talk about how to bet on exploration, but it's important to remember that there's low risk gold gains out there for the picking right now because of the situation that we're in. So straight up leverage means buying favored producers, mid to large tier producers who have controlled costs, strong balance sheets, and don't have standout jurisdictional risk that's flagging them, right? Because these are the low risk exposure opportunities that investors will turn to when they decide that gold is starting to go. Then I would say leverage plus. Leverage is anything that's going to gain because they have ounces in the ground, they're producing ounces, and then the gold price rises. I'd say leverage plus is those where that situation exists, but then you on top of that have the potential for something else exciting to happen. So here, I've been talking in my newsletter a lot about what I see as a building M&A cycle, because producers need more ounces, they don't have it on their own, they need more development projects, all of this. The deals that we've seen so far in the last 2 years, are very reminiscent of the deals that we saw in 2002, 2001, 2003, and those are the deals that created Newmont, Goldcorp, the companies that are the biggest players in the gold space today. They looked around, they saw opportunity, and they made those moves. And so those deals are looking very similar today. And I think what's the next wave of the M&A cycle is going to be mostly, instead of these no premium mergers, which is what we've seen a lot of, I think we're going to shift more towards larger miners taking out single asset operators. And the reason they're going to do that is because there's not a lot of capital in the mining space right now. Those who are investing in larger operators where the risk is lower because it's spread amongst several operations. That means single mine operators are getting lower valuations on whatever sort of per ounce metric you want to use versus larger operators. That simply means that the same mine is going to be worth more in a bigger company than it is in a smaller company. That's the kind of impetus that drives M&A cycles, and that's what we're seeing right now. It started, and I think it's going to continue, so I think single mine operators are clear M&A targets right now. Slightly down the list from that are the ready-to-go development projects. So they're not they're not built yet, but they're ready to be built. There's not very many of these. This is a short list. And when I say ready to go, I mean permitted largely, or advanced down that permitting path. So the major is prepared to take on whatever risk is left in the permitting. Miners really need to restock their pipelines. This is something that we've been talking about for a few years now in the space. But I would say this chart by McKinsey captures it quite well. These are reserves by major gold companies, and they've declined 26% since 2012. Now, of course, reserves decline for several reasons. They decline when the price of gold declines because reserves have to be economic ounces. So gold that was economic to mine at $1,400 gold is not economic necessarily to mine at $1,100 gold. So when the gold price declines, reserves shrink. So that's one reason. But the other reasons are that miners have been mining out their assets and not doing the near mine exploration needed to replace those ounces. And nobody's been doing, there's been I shouldn't say nobody's been doing, but there's been much reduced exploration activity, and especially exploration and then all the work to turn a discovery into reserves. So there just are fewer reserves out there. And so a 26% decline is very significant, and we need to turn that around. Production is also falling, new discoveries are falling. We could talk about this ad nauseum, but the end result of it right now is that miners see a market that's ripe for the picking because prices are low, and they know that they need to act on this. So I really think M&A is going to be a significant factor in the next little while. Okay, so that's sort of the lower risk end of the spectrum, which I do think is really important to consider right now. We also, in this room, probably all like the exploration end of things, the higher risk end of things. I certainly do. And so when you're looking for the higher risk, higher return category, I think that the two types of projects that you want to consider are, first of all, projects that I'm describing as strong and splashy. So strong means they've already got a discovery, they've probably got a resource, it's probably a good resource, and that resource is being advanced towards maybe a PEA. It's on its way. There's a foundational value there. There's a reason to value the company at a particular level because that's there and it's good. But then there's the opportunity for excitement. So maybe that's near deposit exploration, maybe that's regional targets that look really exciting, maybe it's that you think it quite likely that a strategic investor is going to come in, maybe you think the discovery is exciting enough that a nearby miner is going to buy it out. So they have this foundational value component, but then they also have this opportunity for excitement. So I think there's companies out there for sure that exhibit both of those characteristics, and I think they are going to stand out in the next little while as performers. And then on the exploration front, you just have to be very selective. You have to only buy the very best explorers. And to be blunt, the easiest way to identify the very best explorers is who has money. There's very little money out there. So if a team can raise enough money to do enough work that they have the potential to add real value to their project, so not a tiny little exploration program, but one that's large enough. I'm not going to put numbers on it because it totally depends on the project, but one that's large enough that it has the potential to add value to the project. That's always the goal. If they have the money to do that, then they're at least worth considering. And that, unfortunately, and I say unfortunately because there's a lot of good companies and hardworking people out there who are not in that category, but unfortunately they're just not worth paying attention to yet because they won't be able to do anything in the near term and therefore they won't attract attention. But if they have money and they're drilling, and then you also want it to be in a good jurisdiction, and you want ideally for there to be a tight share structure so the share price response to success is strong, and you want, exciting results is the icing on the cake. But really be selective with your exploration picks because there's other opportunities out there right now, and only the very best and only those who are funded are going to give you, or have the potential to give you returns right now. Okay, so these are the kinds of companies that will get the best first gains. And especially on the low risk list, the main risk is the gold price as opposed to each individual company. So that if you believe that the worse the war, the better for gold, is a more stable way to play. Now I just want to say that also in my portfolio, I'm still holding on to other kinds of companies. So I think gold royalty companies, there's several that are building right now, so I'm holding on to those. They may not get a lot of excitement immediately in this move, but I think they just make sense further out. Uranium will happen. Again, could talk about uranium I could have talked about uranium for 20 minutes, so I'm not even going to get into it right now, but uranium will happen. Standout base metal projects have been trampled to the ground. Well, not trampled to the ground. The standout ones haven't been trampled to the ground, but interest is clearly weak. But as I said, the bull is delayed, but it's not going to be denied. So the standout projects I'm holding on to. And then strategic metals are increasingly interesting. They could get really caught up in this trade war. China has recently specifically threatened to restrict exports of rare earth elements, and that would, turn our world upside down. We really need those rare earth elements. So I think that there is possibility in the near term for some excitement on those. So these are other things to either hold on to or keep your eye on as you make those gold moves as well. The chart here is for Lynas Corp, which is a rare earth element producer, and this is the response after China made that threat about not exporting rare earth elements. This is just my closing slide. These are the publications that I produce. My letter is a weekly publication designed to describe what I'm buying, selling, and thinking in the resource space. I also produce a monthly newsletter that is designed to help those who are less familiar with the metals space understand the risk, the opportunity, and some ideas. And then the premium services for those who are interested in participating alongside me when I am investing in private placements. And that's all I have to say for today, and I'm a minute over, which is unacceptable, just FYI. So with that, thank you for your time and attention, and let me ask Larry Phillips of Compass.